Welcome to Seeking Alpha's CEO Interviews. Quality of leadership is a decisive factor in stock performance, so we provide in-depth interviews with the best and brightest CEOs in the public markets. We publish limited excerpts from our interviews on social media platforms and the full interviews at seekingalpha.com and in the highly rated Seeking Alpha mobile app. To find the full interviews, open seekingalpha.com or the Seeking Alpha mobile app and search for the phrase CEO Interviews, or simply type a stock ticker into the search box.
Today we're going to sit down and talk to Michael Murphy, CEO of Rosecliff Capital. Mike, thanks for being with us at Seeking Alpha.
Thank you, Josh. It's great to be here.
Yeah. Tell us a little bit about Rosecliff Capital. If people haven't heard about it, we'll get into SPACs, obviously, in a minute. That's a huge thing that's going on. People obviously don't know a lot about it, and looking forward to diving into all of that coming up right now. Tell us about yourself, Mike.
Sure. So I've been in the financial services industry for about 20 plus years. I had a trading and retail small banking operation, broker dealer, for about 20 years. And about 6 years ago, I realized that the angel investments that I'd been making on the side, like just friends and family type investments in private, basically mostly technology companies here in New York, were, the portfolio was really growing and was really doing well. So thought about building a business around it. So we launched Rosecliff One, which was a seed stage fund. So investing in very early private companies. And that was a $25 million fund. And fortunately, I had a great team that I put together behind me, and we met some great entrepreneurs. So we had good success out of the gates with Fund One, led to Fund Two the next year, Rosecliff Two, which was a $75 million fund going a little later stage, Series A and B deals. The next year we did Fund Three, which was north of 200 million, which was for later stage deals. And then we've kind of followed on each year, Fund 4, 5, 6, and 7, which was a credit fund, which we closed last year. So we're about $1 billion in assets under management now. And we have been very fortunate to meet some great founders, some great entrepreneurs, some companies, a few of the companies that have gone public, a few of the companies that have been acquired. But, some names like Allbirds and Wheels Up and Roman and Casper and Postmates. We've been fortunate to invest in these companies in the private markets. And, we've had a lot of fun doing it. And so far, so good.
So some people have heard about specialty purpose vehicles, SPVs. Some people may have heard about blank check companies. A lot of people have heard about SPACs. Can you tell us a little bit about what a specialty purpose acquisition company is? Maybe some advantages behind that.
Sure. So, there was a time on Wall Street where SPAC was kind of a four-letter word. It was a vehicle for a company that was too small or didn't have the right backing to be an institutional IPO, initial public offering. So they would go the SPAC route. But that's a long time ago. Over the course of the last few years, really 2019, special purpose acquisition companies or SPACs really started to come mainstream. The reason for it, in my opinion, is that you had so many years of companies staying private longer. You heard a lot about it with Uber, where they were raising another $10 billion round and another $10 billion round. And you had companies like SoftBank that had very large checks, large venture capital funds got very big and wanted to invest more large checks. You had more regulations in the public markets. So for high growth technology businesses, a lot of them were staying private longer. As things started to shift, companies said, well, I can now go public. I can get liquidity. I can have a public currency that I can use for acquisitions. I can have my employees getting paid or selling securities so that they have money. So that started to shift in 2019. In 2020, it really took off, where a lot of companies and some of the big ones that you've seen, like Virgin Galactic, DraftKings, to name a few, but there's been so many now, started to go public. And, like we see on Wall Street a lot of times people go to where the success is. So as more and more people were doing it, it got more press coverage. And then people like myself, the venture capital fund managers, a lot of us said, hey, that would be really cool to have a vehicle to take a great private company to the public markets. So it kind of fed off itself a little bit. to the point where maybe it got too big, and the SEC said, hey, we're going to change some regulations around this earlier this year, and really slowed down SPAC IPOs. So to step back a second, a SPAC is a blank check company. So in our case, Rosecliff Special Purpose Acquisition Company 1, or RCLFU, we raised $253 million in an IPO, so listed on the NASDAQ, and that money's in trust. And we're out, we meet with companies, and I have a great team there also, but we're meeting with private companies to do a merger and use our money from trust, 253 million, plus a PIPE, or a private investment in a public entity, use more institutional money to take a high growth private business to the public markets. So that's what a SPAC is, that's what a SPAC does. But you know, I have a very strong feeling about this. You know, you've heard a lot, or your viewers have heard a lot, SPACs are good or SPACs are bad. And to me, that's kind of like saying stocks are good or bad, or IPOs are good or they're bad. And they're neither. There are some great IPOs. Apple was an IPO. There are some terrible IPOs. Same thing with SPACs. So you're going to have some great companies that go public via SPAC, but really it's just another vehicle to get a company from the private market into the public market. Once you're there, it really comes down to execution. It really comes down to whether or not the company can continue to meet expectations, beat expectations, and operate their business in a way that they have followed the business plan. That's what makes a good company versus a bad company in the public markets, whether they got there through an IPO or a direct listing or a SPAC.
What are the differences? I mean, we don't need to get into the intricacies too much, but are there advantages, or what is the ultimate difference for people who don't know the process of going IPO versus a SPAC or RTO?
So the main difference really is that you hear a lot of times a SPAC is a faster process, and you know, it may or may not be. I think it's becoming what you're seeing. It used to be that SPACs were better for smaller companies, and an IPO or a traditional IPO would be better for larger companies. But now you're seeing IPOs coming down and you're seeing SPACs moving up. So I think that's not really the case anymore. The one difference when you're going to list your company through a traditional IPO, you can only talk by law about historical numbers, what you've done in the past. When you want to take your company public through a SPAC, you are allowed to talk about not just what you're doing currently or what you've done in the past, but what you plan to do in the future. So like, you know, a big sector was electric vehicles or battery makers for electric cars. And a lot of them said, hey, you know, we're not doing anything right now, but a year from now or 2 years from now, 3 years from now, gosh, we're going to be doing great. We're going to be making a lot of money. So therefore, we want to get priced on a multiple of where we're going to be in 3 years and go public using that number through a SPAC, where you couldn't do that if you were going through a traditional IPO.
Mm-hmm. Why would an investor why would somebody want to invest in a SPAC? Looks like there's good opportunities for exposure or investing in, you know, tech companies or whatnot, but why would an investor be interested in a SPAC? Yeah,
so it's really not the SPAC, it's the company. So I would rephrase that. Why would an investor invest in an IPO? And there are some great IPOs and some not great IPOs. So really it comes down to an investor has a chance to invest in a company that is going to be, they hope, a great return. And some people may be looking at it as the next Apple or the next Tesla, or they may be looking at the individual name as a quick trade. But it's really, why would someone invest in a you know, small, so between $2, $3, $4 billion range company? An investor would be investing there with the hope or the belief that it's going to turn into, you know, a name, the next Netflix or Apple or Amazon. So it's a chance for the smaller investor. Remember when, you know, Facebook or Uber or even Coinbase, when Coinbase listed a month ago, if you're sitting at home as an individual investor, you buy when they open on their direct listing, it's $100 billion value that you paid. Well, now it's about half that, about 50 billion. But if they had come out at the $2 or $3 billion range, you, the individual investor, have the opportunity, provided the company performs, to partake in the upside in that business. So really, you're doing it to get in early on a high growth story.
Mm-hmm. We're seeing some market corrections right now in tech and cryptocurrencies. Are there potential downside risks for investing in a SPAC?
Yeah, there are, but I would say they're the same as investing in any other new issue, or so they don't have a long history. You don't know the business. You can't point to their last 12 quarters of public earnings because they didn't have them. So it's really, you're investing in an early company. But I would say it's very similar for a SPAC to an IPO. It's a new company listed on the exchange. So if you're going to invest in it, you don't have a company track record to go off. So you have to believe what the company's telling you and hope that the company is able to execute on their plan. And if they're not, that stock price should go lower. Their earnings, if they don't execute, the earnings shouldn't hit the numbers that they're projecting, and therefore the stock should be worth less and the price should go lower. However, if they beat and raise and exceed, those earnings should be more and the price should go higher.
Mm-hmm. So what is some guidance for the SEC? Just looking at the chairman, or at least Jay Clayton, was not too keen on SPACs. So if the SEC is considering some kind of crackdown on SPACs, do you have any SEC guidance on what that's going to mean for the SPAC marketplace?
For sure, they don't want to tip their hand on that. So they came out about 6 weeks ago and said they wanted to change how warrants were treated for SPACs. Really just for me, so for a sponsor, really has no impact on me because we have our financials done by our accounting firm, and then we have our financials audited by our auditors. However, the change that the SEC put in, while it seemed kind of innocuous at first, it's really forced a lot of companies that went out to the public markets via SPAC over the course of the last year or year and a half and have reported public earnings. They have to now go back and restate those earnings. So whether was intended or unintended, I'm not certain, but it definitely slowed down the new issuance of SPACs, because if you wanted to go out and do a SPAC today, you need to have an accounting firm and you need to have an auditing firm. And right now, you are not going to find an accounting firm or an auditing firm that will take your SPAC public unless you've done it 3 or 4 or 5 times before, because they're all have more than they can handle to restate the earnings because of this rule change. So, that one, I think it's just a matter of once people get caught up on that, it's not going to have an impact long term. I guess the one thing kind of from so talking about the individual investors, the retail investors at home, you mentioned crypto. Is Bitcoin worth 64,000 or is it worth 44,000 or is it worth 14,000 where it was to start the year? I don't know. But if you're trading Bitcoin, you need to be aware of the risks associated with it and the corrections that come with it. If you're investing along the same lines, if you're investing in the next hot electric vehicle company or the next hot electric vehicle battery company that has no revenue, has no product, but in 3 or 4 years they're going to, and you're paying a valuation of $5 billion today for the hope that there's a vehicle being sold in 3 or 4 years, you need to be very careful. Now, if you did that with Tesla years ago, it's been a very profitable trade for you. But there's one Tesla, in my opinion. So the odds of you or me finding the next one may be tough. But if you want to go look for that and say, I know there's a huge risk here, but if I get this right, there's going to be a huge reward for me, then good for you. But I think that's one thing where the regulators may come out and try to prohibit companies from giving forward guidance. I think the best way to solve for that, in my opinion, is to really help educate the public and to know that, when you're investing your hard-earned money in any company, a listed company, a private company, a SPAC, an IPO, understand the risk-reward profile of every investment you're making. All that does is help people to avoid getting blown up in a Bitcoin or Dogecoin or whatever it is, or an individual stock, or the market in general, for that matter. If people were more educated around the investing 101, I think that would be great for everybody.
What do you say to people who claim that there's a SPAC bubble? It seems like there's a lot of news about it, and then they seem almost like they're over it. Last year, I think there was a roughly around 247 new SPACs that were formed. There was at least 83 billion in capital through that. And then another interesting stat is between 2019 and 2020, there were more SPACs created in those 2 years than the prior 18 years combined. Is that enough to claim that there's a SPAC bubble?
Yeah, I think that's one of the most important topics around SPACs. And I would say, without question, there is no SPAC bubble. You see the headlines all the time, but again, take out SPAC and put IPO. So there have been more SPACs recently. Last year was a record year, as you point out, roughly 250. And this year we surpassed that in the first 3 months of the year. Fine. But a SPAC, so for instance, Rosecliff Acquisition Corp, our SPAC, is trading at book value. It's at 10. It's trading at cash. There's nothing, no bubble there whatsoever. And there's a lot of SPACs like that are trading at their cash value. And to be frank, that's where they should be trading. For us, we have cash. We should be trading at our cash. We're not worth $11 a share at this moment, but we're also not worth $9 a share. So we're where we're supposed to be. But I think to say we're in a bubble is the same to say, Bitcoin is in a bubble. If you're in at 14,000 5 months ago, you're very happy in this bubble. If you bought at 60,000 2 weeks ago, you're not so happy in the bubble. But I think, I'll point out one kind of well-known SPAC from the company Churchill. There was a SPAC called Churchill 4 that was rumored to be merging with or bringing public the next Tesla, called Lucid Motors. And it was got a lot of publicity. It was around the same time as the GameStop saga was going on. LuxrayBeats. A lot of people were waiting for it, watching for it, reading message boards. There were a lot of online speculation around Lucid and Churchill 4. CCIV is the symbol. So this company that, just like ours, was worth $10 a share, because for the most part, that's where a SPAC goes public, is $10 a share. On the speculation that Churchill 4 was going to be merging with Lucid Motors, which may be the next Tesla, may not be, the stock went from 10 to 20 to 30 to 40, and it got up to $64 a share. It's worth 10, got up to 64 because this rumor they were going to merge with Lucid. Well, they did merge with Lucid, but from 64, now as the news came out, it came all the way back down, and now it's trading in the high teens. So that, I'll say, and it's always easier in hindsight, that was a bubble. That was something that got ahead of itself on just a mania around it, and around people saying you have to own this next best Tesla in Lucid, so you just pay up for CCIV, Churchill. But the idea that the SPAC market is a bubble is kind of, I think, I would argue it's kind of factually incorrect, because there are so many SPACs out there that are trading at their cash value. It's people say the market's in a bubble, but certain stocks are going to do well, certain stocks are not going to do well. In the market, remember, we measure the averages. So if that average is extended and comes down, you could say that was a bubble. But in the SPAC world, now there are some ETFs around it, but when you say SPACs are in a bubble, that implies that all SPACs have reached valuations that are just overheated and where they shouldn't be trading. And that's just factually incorrect.
Mm-hmm. What's your take? You mentioned AMC, Wall Street Bets, and the pervasive risk taking that we're seeing, the speculation in the market that is frothy, that does look like a bubble as we're kind of in this longest bull run in market history. What is your brief takeaway from that Wall Street Bets? And do you think that it's eroding confidence in the market to the point where people are going to look for algorithms? Will AI and machine learning take over public equity investing in the form of automated algorithmic trading, or would it just go back to normal?
I think no. So let me go back a little bit. So 2008 financial crisis, so many people lost confidence. So many individual retail investors threw in the towel at the bottom, or younger generations saw their parents throw in the towel at the bottom, lose a lot of money in the market, and then saw the market just in 18 months go back to making new highs. And so I think there was a generation that didn't have confidence in the markets. And what happened now recently, and again, great way to get the confidence back is lock everyone in their house for a year, in front of a screen, which is what we had with the COVID pandemic. And then you had things like GameStop, you had things like new issues and SPACs and high growth companies, and you had cryptocurrency, and you have people logging on to either their phone or their computer and say, wow, this guy made $1 million trading Ethereum, and this guy made $2 million in GameStop, or $50 million buying call options in GameStop. Wow, that's cool. I would like to do that. So you get the fear of missing out, the human psychology of, I want to get some of that also. And people started to invest. Well, let me change that. People started to gamble on the market. The idea of investing and getting a 10% annualized return that would double someone's investment every 7 years I think didn't have appeal to this generation of investors. It was the idea that you could make 10 times your money in a very short amount of time and post it on social media. I think that was really the allure there. So I've seen things like this coming. I was around in 99 when the tech market crashed. I was around in 08. When I see individual investors coming in and just, with the idea that, hey, I need to take my $10,000 life savings and turn it into $1 million by next month, that just doesn't end well. So I think whatever vehicle they're using, if that's crypto, if it's options, if it's SPACs, if it's IPOs, if it's the market, whatever people are using, if you look at the risk reward parameter, when you're going all in and taking all your chips and pushing them into one company, sure, it's great when you hit, but it's rare that works out for people. So I hope this has brought more people into the markets, and I hope that people understand the risk reward setup better and start to do more investing and less gambling in the markets.
Mm-hmm. So you recently announced a $220 million SPAC, if I'm not mistaken.
It was upsized. We did. It ended up being 253. Okay. 253 million.
253. So between your active investing, so you guys work with each portfolio management company regularly, right? And you guys have a due diligence process. So you guys have an investment team, legal counsel, experienced internal networks, all of that. So obviously before you go in and you invest in a company, there's some serious due diligence. Some of these SPACs are failing, some aren't. Does it come down to due diligence? Can you kind of explain a little bit about what it takes to succeed and why certain certain SPACs fail?
Why the certain, I think a lot of it comes down to execution. There are some companies out there that have executed and done well. One of the best performing SPACs out there, recent SPACs, is Playboy.
Hmm.
It's now, if you had offered me the opportunity to merge with Playboy, I wouldn't have been interested. That to me doesn't sound like something that would be a good long-term investment, but I would be wrong on that.
Mm-hmm.
You had Utz potato chips, another one that's done really well. I wouldn't have seen that either. But then you have DraftKings, and now they're legalizing gambling everywhere. And you're seeing the leagues really get behind the push into gambling, which is another discussion for next time, maybe. So now you look at DraftKings and you say, oh yeah, that's an easy one. Of course, that's going to take off with the legalization of gambling. So I think when you're looking at a SPAC, you don't really have the history of saying like, oh, well, here's what they did last year, or here's what they did last time interest rates were rising or inflation was starting to spike. They're new companies. So I think for it, just on the surface, you want to understand that there's more risk involved with a new company, and there's more risk involved with a newly public company, because they don't have a track record of saying, hey, this CEO and this CFO, their team, they understand how to make the proper guidance, how to meet their guidance, how to beat their guidance, so that analysts continue to raise their estimates, which continue to inflate the price of the stock. So when you're talking about a new company, a newly issued company or a SPAC, a lot of times you're making a bet that the company will execute in the future. Similar to what we do investing in a private company. We're investing at a Series A round at a $20 million valuation with the hope that it becomes a multi-billion-dollar company years down the road. But a lot happens between that Series A round and a public filing of a multi-billion-dollar company, and a lot can go wrong there also. So I think for people at home, they need to understand what it is they're investing in, and look at recent history, like the Churchill CCIV example I gave, and say, well, a SPAC that's just a company with cash that is $10 per share, buying that at $64 a share is probably never going to be a good move for an individual investor. So it's understanding, that you want a great company, you want a great industry, you want a great management team, but you also have to pay a good price as well.
Mm-hmm. So are those all the things you're looking at? A good management team. What about when you're doing your due diligence? Are you looking at the employees as well? Curious about what you're looking at when you do invest in a SPAC, investing in private companies, and how important it is for management and the quality of the staff that they have.
Sure. So just to clarify, so from the SPAC side, we would be merging with when we find the correct company, we'll be merging with one company and being public there. From our fund business, from the Rosecliff Ventures fund business, we have maybe 130 or 140 portfolio companies there. So when we're making investments in private companies, I have a great team behind me that really tears apart. We start with the financials, then we look at the industry. By the time it gets to me, I'm really focused on the management team. So it's less the employees, that sometimes a company may have a team of 8, sometimes they may have a team of 108. But it's hard to get to know each person in each company as you go down the food chain, so to speak. Mm-hmm. But really what I'm looking at is I want a management team led by a CEO that can do great when everything's going well. It's kind of easy to be the CEO of the company. Everyone loves you. Everything's going great. Sales are great. People want to give you money. Everything's great. But there's always a hiccup along the way. There's always a bump in the road. And not every CEO is great at dealing with diversity. So it's a big part of personally for me, when a company gets to my level, I'm really trying to figure out if we want to make a bet on the management team, and real starting with the CEO. Do we believe that this individual and this team have what it takes? So the fact that they got here, there's something to the story. But if things go bad, are they going to be able to? If they will get knocked down. Will they be able to get up? So the management team to me is vital. I can't name one great company out there that is run by a bad management team. So
what about a common denominator of what makes a successful founder? Like when you do find all of these management teams, is there something that you're consistently seeing that all of them possess or have that you find intriguing or is leading towards higher returns? Is there anything that you're grabbing from this management team that is consistent across the board throughout your investments?
trying to, but just short answer, no. White, black, male, female, everything in between. If we could solve for that, it'd be kind of easy, because we'd only back the great CEOs. No, it's because when you're making the initial investment, sometimes you're investing in someone who might be 26, and fast forward now they're 32, married, and have 2 kids. And they might be a different person. They might be better as a CEO, or they might have lost interest as a CEO. There's a lot of things that play along in there. They may have sold tens of millions of dollars of their private stock along the way, so they're not as incentivized where they have to make this work. So there's so many factors in there, but no, they need to be hungry. They need to be good leaders, but it's really hard to in the time that we spend with them, we're trying to get that part right. Because if I could say we only back the best CEOs and the best management teams, my job would be a lot easier. But it's sometimes we try to do that, but there's really not. I mean, when people, I'd say pretty much all of the founders who we meet with, that we are considering investing with, they know enough to come in and put on a great show. Like my job is really to try to understand who's just acting and isn't really good at what they're saying they're good at, and who really is good. And when you get that part right, and you see a company that is forced to pivot and is really rocked, and could potentially be put under, and you see a management team really pull the company up by their bootstraps and rally everybody and have to lay people off, but be able to rally and get lean and cut salaries, and then turn it around and make progress, and then become an even bigger and better company than you envisioned. That's the best investing. When it starts out and goes right, it's great. But when there's some rockiness in the middle, it becomes even more rewarding, if that makes sense.
There's a couple of companies, I guess I'll just list them. WeWork seems to be one that wanted to go public at a $47 billion, 40-something billion dollar valuation. They just lost $2 billion that I'm aware of, when their market cap was really only 3 or 4. So they're trying to go to this public markets to sell everybody on that $47 billion valuation. But now, do you kind of see that? There's another one I'll mention, MedMen in the cannabis space. A lot of publicity, a lot of excitement about the retail operations and being a multi-state operator, and then without the proper management, like you described, kind of just crumbled. I would think the same thing with WeWork. Management wasn't probably equipped to handle that type of volume, market cap expansion, scaling, all of that. Do you kind of see those companies having a second life through SPAC? What do you think is going to happen with WeWork specifically?
Yeah, so it's a great one. So WeWork, it started as a great American success story. This startup and a kind of a charismatic CEO who, had built this almost $50 billion enterprise, and then things turned on it. And now, you have someone like SoftBank who had billions of dollars invested in the company on the way up, and then they came in and added more to their position on the way down. And now, as they go public through a SPAC, what happens to WeWork? What's the future of WeWork? I think that there's an argument to be made that WeWork, when it goes public, it has great upside. Especially as the economy unlocks, as people are getting back into the office, as maybe there's more people working semi-remote, semi in the office, or larger offices opening satellite space. So there's a lot there for WeWork. But WeWork is a company that, easy to say now, got way ahead of itself, and easy to say now looks like maybe there were some management mistakes there. And that's one company that if you invested at the high level in the private markets, you didn't do well. But now it's reset in the public markets as it goes public through a SPAC. And I'm really interested. I'm watching that closely because I think the sentiment is so negative. People think WeWork bad. And I don't think that's the case. I think I want to see, so I wouldn't invest in WeWork today or through the SPAC today, but I will watch it closely. And I think they have I think they have an opportunity to rewrite their story. They have an opportunity to execute on their business plan. And if they do, they're going to get rewarded with a higher stock price.
Yeah, it helps when you can get rid of about $40 billion on that valuation. That makes it look that much better. But I kind of want to ask you about the outlook for SPAC. So being a SPAC, you're used to giving forward guidance. And so with the FOMO that we've seen in Bitcoin and some of the individual equities, I'll throw out, maybe Tesla out there with a very high price, 1,350% price to earnings ratio is pretty high. That means you're going to be expecting something to be coming down the road eventually. I'm wondering what you're expecting to come down the road eventually. Where are you seeing the highest demand for investors, and what's your SPAC outlook for 2022 and beyond?
So I think there is a very healthy appetite for people who want to invest in the next Tesla, the next Netflix, the next Apple at a very early stage. When you're doing that, you're going to end up investing in the next WeWork at 40 some odd billion dollars and have it go down. So they're not all going to work out for you. But I think right now we're seeing a lot of interest in areas that are driven by technology, but where it was pulled forward during the pandemic. For instance, telemedicine. That was something that I think was coming to the forefront anyway. How you visit your doctor, how you receive your medicine. But I think when everyone was stuck at home and couldn't go to the doctor and couldn't get to their pharmacy, that pulled the entire telemedicine industry forward by a couple of years. And I think there's still a lot of interest there, and a lot of interest in kind of helping through telemedicine, helping solve for the healthcare problem we have in this country. Another one is fintech. We talked about it before, investor education, and you see Robinhood, you see the cryptos, you see Coinbase. People are more aware of the markets right now, and I think people want to know how to invest and want to take their money and see a return on their money, a positive return. And they also want to know about setting up their families for things like wills, and setting themselves up for insurance, and setting themselves up just to have a healthier financial picture as they get older. So I think fintech is also another area. So those are two areas that we focus on a lot, where I think a lot of people, pretty much everyone out there, deals with a doctor or medicine in some way, and deals with money in some way. So if you can help the consumer do that better, faster, with a better result for less money, there's a great opportunity there. So there's a lot of companies coming into that space. One that I'll say, the electric vehicle space. I own a Tesla, but I don't own the stock of Tesla. I think there are going to be a lot of electric cars out there. Uber's made the statement that they're going to have all electric cars. But everyone's making them now. So I don't see me ever picking the next Tesla or knowing if that's going to be Lucid or Rivian or Ford or Porsche or Mercedes or who's going to do that, who's going to be the winner there. I don't know. So that's what leads people to say, well, I'll invest in the batteries. I think that industry is going to be here to stay. I'm not really sure how to profit from that, because I think a lot of the companies that I've seen anyway are talking about owning a big, say 25% of the total market in batteries that's going to grow 100x over the next 5 years. But there's 10 companies that are claiming they're going to own a quarter of the market. And you do the math, 10 companies can't own 25% of one market. So there's going to be some winners, and there's going to be some losers also. So that's one that for me is kind of, and I'll add space exploration in there as well. If I could figure out who can build the best rocket ship, I may not be here speaking with you right now. So, that's one that's great. I love it. I love watching it. I love reading about it, but I don't see how I can profit from it or make money from it. So one thing I've learned in 25 years of investing is I can watch that from a distance. Similar to cryptocurrency, I'm watching it. I'm not investing in it, and I'm okay with that. When it takes off and goes up, I'm okay with the portfolio that I have. May change at some point, but I think that's one thing I'd say for individuals is that this idea, getting caught up in the fear of missing out is a great way to lose money. So kind of like having a plan, knowing what you know, and kind of investing around that sounds really simple, but it's something that's always worked for me. So I think that there's going to be a lot of great private companies, because we talk about hundreds of SPACs. There are literally thousands of great private companies. So there are enough companies to come to the public markets if they want to, whether it's through a SPAC or through an IPO or through a direct listing. So there's a lot of companies out there. It's just when you're everyone, we all know Apple's a great company, kind of not really disputable, but how much, from 2.2 trillion, how much upside do you see from there? What if you could get into potentially the next Apple at 2 billion and it goes to 2 trillion? Wow, there's a big reward there, but you're obviously taking on risk. So understanding that part, and I think investing in things just make it easier for you to understand.
Mm-hmm. So a lot of people are going to be going back to work here pretty soon. So I'm going to leave you with this final question. Being at the forefront of consumer technology investment for years and years, what's going to come first? Fully automated, fully self-driving cars, or the drones, the human drones that can fly us, where we need to go? Man, what's going to come first?
I don't know. I'll tell you. We invested in a company called Jetpack. And they're making not just the Iron Man type jetpack, but also flying motorcycles. We've invested in another company called Tortoise that's making automated grocery delivery robots. So we're getting there. But if a car pulled up, I have 6 young children. If a car pulled up to my house without a driver, and you said put your kids in there, I'm not putting my kids in there. Maybe I'll get there at some point. So which one comes first? I think partially automated driving. Maybe that's a cop out, but I'll say partially autonomous vehicles will be here soon. And the technology's there. We're sending people to the moon. I think we can figure it out. But I think it's going to take a while to get there. And even if if I could tell you exactly which sector it's going to be, you then have to figure out as an investment which companies are going to succeed there, and that becomes that much more difficult. So, I'd like to get a little more certainty around that. But as I say, we've started to look at the space. We've started to invest in the space, and the one thing that I'll say is a given is we have great technological advancements happening in this country right now. So the last thing, you throw anything out at me, I'm probably not going to tell you we can't do that. I think we have the some great founders, great entrepreneurs, and great technology. I think there's a lot of change you're going to see over the next 5 to 10 year period.
Mm-hmm. Yeah, if you can get a beer on a golf course already delivered by drone, and then a pizza delivered automatically, you know, maybe eventually you'll be throwing your kids in a car, because if your pizza's safe, maybe eventually your kids will be safe.
Pizza kids, I see where you're going with that, but you know, I guess the one thing, if they could guarantee me the 6-foot putt on the golf course, they can keep the beer and the pizza. If I could make those 6-foot putts, if you have a company that can do that for me, I'll invest in that.
Yeah, ultimately that's the value you're looking for, right? That's it. All right, I appreciate your time. Is there anything that we left out? Anything you want to plug right now? How they can contact you? All that good stuff.
No, this has been great. You know, we're on, you know, we're online, and you know, things we get a lot of traffic coming through here, and you know, it's just I love to help individual investors where I can. A lot of times it's from mistakes I've made personally, and kind of say, hey, here's what I did wrong, so don't do it. So, you know, I'm always happy to help individual investors. I think it helps the collective country if, you know, more people can make good decisions with their money.
All right, with that, we're going to roll this one up. I want to thank my guest, Mike Murphy, CEO of Rosecliff Capital. Mike, thanks for being with us at Seeking Alpha.
Lots of fun. Thank you very much.